Chief Research Officer for Vistage, here to share the insights and analysis from the Q4 2024 Vistage CEO Confidence Index. The Q4 2024 Vistage CEO Confidence Index soared nearly 16 points to 100.8, driven by expectations of a more pro-business administration and expectations for a strong economy in 2025. All the indicators are flashing green, as 55% of CEOs believe the economy will improve in the year ahead. That's up from just 32% last quarter and more than double the 21% reported at this time last year. The proportion of CEOs expecting increased revenues grew by 13 percentage points, while those that are expecting increased profits grew by 12 points. Outside the stimulus-induced surge of 2021, these are the highest expectation levels since late 2018. Those that plan to increase fixed investments increased to 41%, the same level as Q4 of 2019. As a strong indicator of confidence, 65% of CEOs are planning to increase headcount, up 15 points, which is equal to Q4 2018, above Q4 2019's 63%, and just below the record high of 71% from Q4 2017. This all suggests a growing economy in the year ahead that will be driven by lower inflation, falling interest rates, and a stable, at least for now, employment landscape. We look to our partner, ITR Economics, for their expert perspective and guidance. Once again, we welcome back our friend, Lauren Seidel-Baker, Senior Economist at ITR. Lauren is co-host of the ITR By the Numbers podcast and has been interviewed on NPR Marketplace, Bloomberg, and many others. Many of our members have had and will have the opportunity to see her at our Vistage Executive Summits. Welcome, Lauren. We're great to have you here to help us connect CEO sentiment captured in the Vistage CEO Confidence Index with ITR's economic analysis.
Thanks, Joe. I'm so happy to be here and so happy to dive into these numbers.
Great. Well, Lauren, the confidence index soared in Q4.
Yes.
It's a leading indicator of good things to come in 2025. How does that connect to the leading indicators that are part of your forecast?
It is, first of all, so great to see this liftoff. We have been watching both the CEO Confidence Index and other leading indicators be a little bit more muted in their rise. So we have still seen good things, but just not breakaway great growth. So our view is for growth in 2025. We've been saying that for quite some time now, that 2025 will be a better year than 2024 was. You cited some of the fundamental factors behind that, but we're also seeing some removal of the uncertainty on the business side. And you quoted a few of the big drivers. We see the uncertainty of the election being behind us. So a lot of the businesses who had just been in wait and see mode, they're ready to get off the sidelines, get out of belt tightening mode and dive back in. Interest rates, I think, are the big factor here. We've now seen 100 basis points of interest rate cuts this cycle. That's going to be stimulative. That lowers the cost of borrowing. That just makes these businesses, it's a little easier for them to get out to invest in their business, even if they do need to take out debt or borrowing at this slightly lower cost of capital. That will help. But again, this isn't runaway growth. There is still some uncertainty, and those interest rates have not fallen back to previous lows. So we are still at a moderately higher cost of borrowing, but the message that we have been giving at ITR is that borrowing still makes sense to invest in your business, to invest in those efficiencies, even at this slightly higher level. And that's where it seems like a lot of CEOs and businesses are coming down these days.
Recently, Brian Bolio shared that the Vistage CEO Confidence Index also leads CapEx by about 10 months. Can you comment on that and what that means?
Yes, and I think there's a lot of logical relationship. It certainly makes sense as a leading indicator for CapEx spending. You quoted even the percentage of these CEOs who expect to do fixed capital investment. So we're seeing that sentiment really flow through the business world. The same factors are being reflected here that, again, will probably spur that new investment come 2025. We certainly hope that you're taking our messaging here, our outlook from ITR, getting on board with that view that there is going to be more demand next year. So you need to be in the position to meet that elevated demand. If that takes more fixed investment, if that takes additional CapEx spending in one way or another, well, I think that is still well worth it. As I said before, even at this slightly higher cost of borrowing. So again, I'm not surprised to see that logical relationship. We do see the CEO Confidence Index correlated to other sectors of the economy, again, to these other kind of broad economic outcomes. We can show a number of different charts with that strong correlation, but this is a good signal for us. It's showing that liftoff in things like the industrial economy. I expect some measure of correlation to continue with GDP overall. And as you mentioned, total CapEx spending, that's a very compelling relationship in my mind.
Well, let's talk timing then, because we know that 41% plan on increasing investments. That's in line with the second half of the 2010s, so it's a strong level.
Mhm.
But our data showed 35% of CEOs will make their planned investments in the first half of 25, while 30% will be making investments over the course of the year. What's your thoughts on timing of when to find that low point to take that money and do what you need to do?
Sure. So every industry is going to be a little different. As I'm talking general timing, let me target that right now to our general kind of industrial space, the manufacturer overall. Clearly, certain sectors like residential construction, that moves a little bit ahead of the overall economy. Non-residential construction tends to lag a little bit. That's why it's important to know your own leading indicators and your specific timing. But just for that broad-based kind of diversified client, I think the sooner the better. We are already seeing recovery trends in things like the US Industrial Production Index. We're starting to see those green shoots for manufacturing and for many of those kind of subcategories within manufacturing. Not all, so this isn't the most symmetrical across the board growth that we'll ever see. But by mid 2025, I do expect that demand to be picking up. So that's when you'll want to have this investment in place. If you're gaining efficiencies, if you are installing new equipment, if you need to train people up on those new pieces of machinery that you're installing, you need to allow some amount of lead time before you want these things actually working and producing output. Now, when we couple this with interest rates, I'm sure we'll talk about the Federal Reserve a little bit later, but you'll note that they did in their recent economic outlook suggest fewer rate cuts will be appropriate in 2025. We at ITR have been signaling that risk for quite some time, that the market was building in more cuts and critically building in interest rate cuts deeper into 2025 than we had been expecting with our inflation outlook. So I think the risk here is businesses wait too long because they think they might get just a little bit more benefit on the interest rate side. So if you are, really waiting for those last 25 or 50 basis points of cuts, you could end up missing, first of all, the bottom of the cycle, but you could end up waiting too long. And I would ask, what is the trade-off in terms of having this investment in place, up and running in time? Is that really going to be worth another, say, 25, 50 basis points on the borrowing side? That's for everyone to determine. But again, it's hard to pick the low. I'm really looking for the first half of 2025 to be that best time to borrow, and I'll kind of lose opportunity as we head later in the year.
Well, to turn our attention to another area of investment, that's hiring. We see 65% are planning to add headcount in the year ahead. Growth cycle's spinning up. What are your thoughts on the labor market and what that means for CEOs?
I'm thrilled to hear that more CEOs want to hire. I would only question, where are you going to find these people? Even today, with this loosening we've seen in the labor market, we still have fewer than one unemployed worker for every one available job opening. So at the end of the day, it becomes a demographics issue. We are seeing more retirements than we are seeing new entrants to the labor market. So the baby boomer generation, they're held on longer, but they are finally now exiting those jobs. The new generation, Gen Z, who is aging into the workforce, they're actually a much smaller generation. And if you look at our prime age workforce, they are currently participating in the labor force in much higher numbers than is historically, well, let's say for the past 20 years. This is a high in labor force participation. So that means we have fewer folks sitting on the sidelines to draw back into the labor force, fewer younger workers who are just starting to enter. So the risk for me here is long-term demographics don't support a growing labor market of availability. That means businesses are going to have to be a little bit smarter. At the end of the day, this probably means higher wages. You will have to keep an eye on that wage inflation component, because the easiest way to compete for workers is just to pay them more. So if you don't get better productivity out of them, that will be a continued margin squeeze. But there are some other creative solutions, right? What makes your business a good place to work? Is it the culture? Is it the environment? Is it the leadership team, right, that you really believe in? There are things that you can do. Overall, though, I would say budget for higher wages. And at the end of the day, you'll need to get more productivity out of these people to make that margin worth it.
Well, let's spin on that as a quick follow-up. AI has been gaining traction with knowledge workers as a driver of individual productivity. What are you seeing? What are you hearing? What is your sense about AI being a solution, or a partial solution, at least, to the hiring challenge?
I think it has to be part of the solution because I just don't see another solution on the horizon. It's not immigration right now. It's not that we can bring more people in to, fill all of those open positions. And as we get more demand in 2025, that pinch is going to get tighter again. So maybe there are AI, automation, some kind of tech solutions. I'm so excited about this, but I have to admit to you, Joe, I haven't seen it. I really haven't seen the rubber meet the road quite yet. I look at, as you know, the broad scale of things. So overall labor productivity, I just haven't seen it pick up with this AI revolution. The numbers aren't there quite yet. So while I'd like to believe there are ways we can use that, I'm concerned that for many businesses, they're using this kind of scattershot approach. I'm going to fund AI research on my company. I'm going to fund AI, adoption, but I don't have a target. I'm just kind of throwing money at the problem and seeing what results. The result, at least to this point, hasn't yet been one of better productivity.
Well, time will tell on that, but clearly it's not going to solve the coming labor challenge we're going to have as this economy grows. Thank you, Lauren, for your time. Your guidance and analysis will help our leaders of small and mid-sized businesses understand what to expect as we enter 2025 and the second half of this decade. We look forward to our March CEO Confidence Index survey to see if the optimism is sustainable or just a post-election spike when we discuss the year ahead with our analysis of the Q1 2025 Vistage CEO Confidence Index.